The power of capital budgeting in investment analysis is immense. It forms the backbone of strategic financial planning, aiding in sound decision-making and efficient resource allocation. Hello viewers, and welcome to our comprehensive guide on investment analysis and the transformative influence of capital budgeting. In this video, we delve deep into the dynamic realm of financial planning, exploring the core strategies, methodologies, and tools that shape successful investments. Join us to unravel the essential concepts behind capital budgeting, understand its pivotal role in investment decisions, and discover how it can propel you towards financial success. So let's dive into the video. Investment analysis, the power of capital budgeting. Within the multifaceted realm of finance and business management, investment analysis emerges as a pivotal cog in the wheel of decision-making. In particular, capital budgeting stands tall as a fundamental process that embodies strategic financial planning, meticulous forecasting, and the critical evaluation of potential investments. At its core, capital budgeting serves as a guiding compass, enabling businesses to allocate their financial resources judiciously towards ventures that promise not just immediate returns, but sustained profitability and long-term growth. Understanding capital budgeting. Capital budgeting, often referred to as investment appraisal, constitutes the financial planning methodology used by companies to assess and analyze potential investments in tangible assets. These assets might include new projects, machinery, facilities, or equipment. This comprehensive process involves the allocation of financial resources towards ventures anticipated to yield returns over an extended period, typically longer than 1 year. Key components of capital budgeting: project identification and generation. The journey within the domain of capital budgeting predominantly initiates with the critical phase of identifying and generating potential projects or investments. This initial step involves a comprehensive array of activities aimed at sourcing and conceptualizing potential ventures. Idea generation, brainstorming sessions, and innovative thinking converge to explore and conceive opportunities that align intricately with the company's overarching strategic objectives. The process isn't limited to mere ideation. Rather, it extends to conducting rigorous feasibility studies and detailed market analyses. These studies are instrumental in delineating the most viable and promising prospects, employing a mix of statistical data, market trends, and consumer behavior patterns to pinpoint opportunities with the highest potential for success. Estimation of cash flows. Forecasting cash flows linked with potential investments emerges as a pivotal and intricate facet within the landscape of capital budgeting. This phase necessitates an intricate and detailed analysis, compelling the exploration and projection of cash inflows and outflows throughout the investment's projected lifespan. Delving into this estimation involves a meticulous examination of various financial elements. This encompasses comprehensive considerations such as revenue streams anticipated from the investment, meticulous evaluation of operational costs, including but not limited to direct costs, administrative costs, and indirect expenses. Furthermore, it involves the assessment of depreciation and potential salvage value, requiring an in-depth understanding of asset values and their depreciation patterns over time. Such intricate projections are paramount as they aid in painting an accurate and detailed picture of the financial landscape the investment is expected to traverse, thereby allowing for more informed decision-making processes. Evaluation of cash flows. At the core of the capital budgeting process lies the comprehensive evaluation of forecasted cash flows. This stage involves employing a myriad of financial metrics and tools to comprehensively gauge the potential returns and viability of the investment. Metrics such as net present value, NPV, internal rate of return, IRR, payback period, and the profitability index are diligently utilized to assess and quantify the projected financial gains and potential risks associated with the investment. NPV, for instance, takes into consideration the time value of money, providing a comprehensive evaluation of the investment's potential profitability. IRR, on the other hand, delineates the projected rate of return expected from the investment, enabling comparisons with alternative investment opportunities. Risk assessment. The comprehensive assessment of risks associated with potential investments stands as a critical pillar in the capital budgeting process. This involves an exhaustive evaluation and analysis of an array of factors that have the potential to impact the investment's performance. Market risks, technological changes, regulatory influences, geopolitical shifts, and other external elements are meticulously scrutinized. The aim is to delve deep into these elements to identify potential threats and challenges that the investment might face throughout its lifespan. Assessing these risks requires a holistic approach, one that encompasses a thorough analysis of market dynamics, future technological advancements, potential changes in regulations and policies, and any external factors that might disrupt the investment's operations. By identifying and analyzing these risks comprehensively, companies can implement strategies and mitigation plans to minimize the impact of these risks, thereby safeguarding the investment's performance and returns. Decision-making. The pivotal culmination within the capital budgeting process revolves around the realm of decision-making. Based on the in-depth analyses and evaluations conducted across various financial dimensions, a well-informed decision is reached regarding the acceptance or rejection of the investment proposal. This decision-making process encompasses a rigorous evaluation of the potential risks and anticipated returns derived from the investment. It involves a comprehensive weighing of the financial metrics, risk assessments, and potential impact analyses, ultimately resulting in an informed and strategic decision. The evaluation doesn't merely stop at assessing the financial aspects. Rather, it extends to considering the alignment of the investment with the company's strategic vision, its compatibility with the existing infrastructure and operations, and its potential contribution towards the company's long-term goals. The power of capital budgeting. The significance of capital budgeting extends far beyond just a financial evaluation. It stands as a strategic pillar that efficiently guides companies in their long-term decision-making processes and resource allocations. Its impact permeates various facets of business operations. Resource allocation efficiency. Capital budgeting ensures the optimal allocation of resources, thereby preventing wastage and enhancing the efficient utilization of capital. Long-term growth and sustainability. By rigorously evaluating potential investments, companies can make informed decisions that foster sustainable growth and stability in the long run. Risk mitigation. The meticulous evaluation of risks associated with an investment allows businesses to anticipate, plan for, and mitigate potential challenges. This process substantially aids in reducing unforeseen losses or setbacks. Enhanced performance measurement. It provides a mechanism to measure the performance of an investment against predefined benchmarks. This, in turn, enables companies to derive valuable insights from both successful and unsuccessful ventures. Tools and techniques in capital budgeting. Numerous tools and techniques are employed to facilitate the capital budgeting process, enabling a comprehensive analysis of potential investments. Net present value, NPV. This tool measures the present value of future cash flows by discounting them at a specified rate, thus indicating the project's profitability in today's terms. Internal rate of return, IRR. The IRR represents the discount rate at which the net present value of cash flows becomes zero, indicating the project's returns. Payback period. This technique evaluates the time taken for the initial investment to be recovered from the project's cash flows, indicating the break-even point of the investment. Profitability index. This metric assesses the relationship between the costs and benefits of an investment, aiding in decision-making by quantifying the investment's potential return in relation to its cost. Challenges and limitations. Despite its effectiveness, the capital budgeting process encounters several challenges. The inherent uncertainty in forecasting future cash flows, the fluid nature of changing market conditions, and the complexities of evaluating intangible benefits often pose significant hurdles within this strategic evaluation. Moreover, the methodology employed in capital budgeting can sometimes be rigid, potentially neglecting opportunities that fall outside the usual evaluation criteria. In summary, investment analysis through capital budgeting is an indispensable facet of sound financial management in the contemporary business landscape. Its strategic significance in aiding businesses to make informed decisions regarding long-term investments cannot be overstated. Thank you for joining us on this illuminating journey through investment analysis and the impactful world of capital budgeting. Don't forget to like, share, and subscribe for more exclusive insights into the realm of finance. Remember, the power of capital budgeting can unlock your pathway to financial success.